I need you to stop scrolling right now. Not in a minute, not after you check your notifications, but right now. Because what I'm about to show you is not some prediction, not some theory, and definitely not the usual noise you hear everywhere else. Something just happened in the silver market that only occurs once every few decades. And I'm not exaggerating. This is the kind of event that separates people who understand money from people who think they do. By the end of this video, you'll see the financial system differently than you did 30 minutes ago. And that shift in perspective, that's worth more than any trade you'll make this year. Silver just moved in a way that broke every normal pattern. This wasn't a gradual climb where traders slowly pushed the price higher. This was an explosion. The kind of move where you look at the chart and your brain takes a second to process what just happened because it seems impossible. Price didn't walk up the stairs, it jumped out the window and landed 3 floors higher. And here's what matters. This type of violence in price action doesn't happen when everything is fine. It happens when the structure underneath the market starts cracking. When the foundation that everyone assumed was solid turns out to be built on sand. This is dark economy, and if you're tired of mainstream financial media telling you everything is under control while the ground shifts beneath your feet, hit that subscribe button right now. I mean it. Not later, not maybe, but now. Because videos like this one have a short shelf life. Once everyone figures out what's happening, the opportunity disappears. The early people win, the late people pay. It's that simple. And drop a comment below telling me where you're watching from, because I read every single one and it helps push this message to more people who need to hear it. Your comment isn't just engagement, it's a signal that tells the algorithm this information matters. Share this video with someone who thinks their savings are safe in the bank. They need to see what's really happening. Don't wait until the end. Do it now while you're thinking about it. Now let me take you behind what just happened, step by step, so you understand not just what occurred, but why it occurred and what comes next. Because this story isn't over. In fact, we're probably still in the early chapters. And the people who understand that will be positioned completely differently than everyone else when the next phase begins. For weeks before this explosion, something strange was happening that most people didn't notice. Silver in the United States was trading cheaper than silver in other parts of the world. Now, you might think that's just normal market variation, but it's not. When the same physical item trades at different prices in different locations, that's not variation, that's opportunity. And when that gap gets wide enough, the market has to correct it. It's not optional. It's physics, it's arbitrage. And arbitrage opportunities don't last long because people exploit them until they close. China in particular was paying significantly more for silver than Western markets. We're not talking about small differences here. We're talking about gaps large enough that shipping metal halfway around the world and still making a profit became not just possible but obvious. Think about that for a second. The cost of physically moving tons of silver across an ocean, dealing with customs, insurance, storage, and you still come out ahead. That tells you the price in one market is completely disconnected from reality. It tells you something is fundamentally broken in the pricing mechanism. Markets lie all the time, but they can't lie forever. Gravity always wins. When price in one place is artificially low and price in another place reflects actual demand, something has to give. And what gave was the Western paper price. It gave violently. It gave all at once. Because pressure that builds slowly releases explosively. Here's what happened behind the scenes that most people will never understand. The large institutions, the banks and big traders who normally step in to sell when price starts rising, they disappeared. They just vanished from the market. Why? Because they did the math. Selling silver cheap in New York when someone can immediately buy it and ship it to Asia for a profit meant they were handing money to anyone smart enough to notice. So they stopped. They pulled their offers. They stepped aside. And without those institutional sellers providing liquidity, the market became dangerously thin. And when buyers entered the market expecting to find sellers at reasonable prices, there was nothing there. No inventory, no willing sellers, just empty space. So price had to jump, not to where sellers wanted to sell, but to where sellers even existed. That's a liquidity vacuum. It's what happens when the buffer disappears. It's what happens when the market maker decides the risk isn't worth the reward anymore. In a normal, healthy market, there are sellers at every level. Price moves up smoothly because as it rises, more people are willing to sell. It's gradual, it's predictable, it's orderly. But when inventory vanishes, when there's no one on the other side of the trade, price doesn't move smoothly. It skips, it gaps, it jumps over entire levels because there's nobody there. And that jump you just saw, that was the sound of a market realizing it's been wrong for a very long time. That was years of mispricing correcting itself in hours. Even after this massive move, silver in Western markets is still cheaper than in Asia. Read that again and let it sink in. Even after the explosion, even after the gap up, the arbitrage opportunity still exists. That's not normal. That's not healthy. And that means this move isn't finished. As long as there's a spread, as long as buying silver in one location and selling it in another makes money, the pressure continues. Algorithms don't have emotions. They don't care about your opinion or mine. They just see the spread and they execute, over and over until the spread closes or until something breaks. Now think about the people who were betting against silver just a few days ago. Short sellers. Traders who borrowed silver or sold futures contracts expecting price to drop. A small move against them is uncomfortable but manageable. They can wait it out. They can add to their position. They can average down. But this wasn't small. This was catastrophic for anyone on the wrong side. Losses didn't accumulate gradually over weeks. They stacked instantly in a single session. Margin calls hit. Brokers don't ask permission. They liquidate. Enforced buying is the most aggressive buying there is because it doesn't wait for a good price. It just buys at whatever price exists right now. Market orders, no limits, pure desperation. That short covering added fuel to a fire that was already out of control. Higher prices triggered more margin calls. More margin calls meant more forced buying. More forced buying pushed prices even higher. It's a feedback loop, and it's vicious. Once it starts, it feeds itself until every short position is either closed or destroyed. And here's the thing. Most people don't even see this happening. They just see price moving and they think it's normal market activity. They don't realize there's panic happening behind the scenes. They don't see the desperate phone calls, the emergency meetings, the traders watching their accounts implode in real time. You would think that after such a dramatic price move, physical silver would become easier to buy. Supply would increase, dealers would compete for customers, premiums would drop. Economics 101 says higher prices bring out more supply. But the exact opposite is happening. Go check any major dealer right now. Premiums aren't falling, they're rising. Inventory isn't flooding the market, it's disappearing. Dealers are pulling products offline or marking them out of stock. Why? Because they know replacement cost is higher than the current screen price. They know if they sell an ounce today, buying it back tomorrow costs more. So the safest move is to not sell at all. Better to have no revenue than to lose money on every sale. This is critical, and I want you to really understand this point. When physical leads paper, when the real price of metal in your hand moves faster than the price on a screen, that tells you the move is real. It's not speculation. It's not hype. It's not social media excitement. It's repricing. The market is correcting an error that existed for years. Silver is a strategic metal. It's used in solar panels, electronics, defense systems, medical equipment, water purification, photography, batteries, mirrors, and countless other applications. It's not optional. It's not replaceable in most applications. There's no substitute that works as well. And it cannot trade like it's infinite when it's not. Scarcity always wins eventually. Always. The chart is just catching up to what reality already knew. Now let's zoom out because silver isn't moving in isolation. Gold just did something that almost never happens. A multi-percent move in gold in a single day is extremely rare. Gold doesn't do that. Gold is stable. Gold is boring. Gold is the adult in the room. When gold moves aggressively, it's telling you something broke behind the scenes that most people haven't noticed yet. It's a warning signal that the professionals are seeing risks the public doesn't understand. Gold is not a meme. It's not a trade. It's not something people buy because they're bored or because some influencer told them to. Gold is the foundation of trust in the monetary system. It's what central banks hold. It's what sovereign nations stack. It's what has been money for 5,000 years across every civilization. When gold moves violently, it means big money is scared. Institutions don't chase trends. They don't follow crowds. They move early. They see risk before headlines talk about it. And when they move into gold fast, when they're willing to pay any price to get in, it's a warning sign that something serious is happening in the background. Silver reacts to the same fear but with higher sensitivity. Think of gold as the dam and silver as the spillway. When pressure builds, gold moves first, and then that pressure overflows into silver. But silver is smaller. It's tighter. It's more volatile. It's more leveraged to the same underlying forces. So the same amount of capital creates a much bigger move. That's why silver feels explosive compared to gold. It's not because silver is more important, it's because silver is more sensitive. It's the canary in the coal mine. There's also something most people completely miss, a substitution effect. As gold becomes expensive, as it pushes toward $3,000 or $4,000 per ounce, regular investors and smaller buyers start looking for alternatives. They want the same protection, the same store of value, the same insurance against currency debasement, but at a price they can afford. Silver becomes that alternative. It's the accessible version of the same idea. It's gold's little brother, and when that shift happens, when even a small percentage of gold buyers redirect into silver, it overwhelms supply. Because the silver market is so much smaller than gold. The entire above-ground supply of silver is worth less than some individual companies. It's a tiny market, trying to absorb massive flows. Now let's talk about industry, because this is where things get really serious and where most investors completely miss the picture. Investors buy silver because they want to. They're making a choice. They can change their mind tomorrow. Industry buys silver because they have to. They have no choice. Factories don't care if silver is cheap or expensive. They care if it exists. They care if they can get delivery. Silver is a tiny part of total production cost for most products, often less than 1%, but it's a critical component. Without it, production stops. The entire factory shuts down. Workers go home. Revenue stops. And when price jumps suddenly, industrial buyers don't wait for a pullback. They don't try to time the market. They don't call their technical analyst. They panic buy. They secure supply immediately because availability matters more than cost. Paying double for silver is fine if it keeps a billion-dollar factory running. This creates a dangerous cycle that accelerates quickly. Higher prices trigger industrial hoarding. Companies that normally keep 30 days of inventory suddenly want 90 days. Hoarding drains available supply from the market. Lower supply pushes prices even higher, and round it goes. This is how shortages accelerate. It's not linear, it's exponential. The fear of not having silver tomorrow makes companies buy twice as much today, and that behavior itself creates the shortage they fear. It becomes a self-fulfilling prophecy. Dealers face the same problem from a different angle. If you're a bullion dealer and you sell inventory today, you have to replace it tomorrow to stay in business. But if price is rising fast, replacing inventory costs more than you just sold it for. You lose money on every transaction. Your business model breaks. So what do? You stop selling. You raise premiums to levels that protect your replacement cost. Or you just mark everything out of stock and wait. That's why you see notify me when available instead of discounts. That's why wait times stretch from days to weeks to months. The market isn't cooling off. It's freezing up. It's seizing. The paper price might say one thing, but the real price is what it actually costs to get metal delivered to your door. And that gap between paper and physical is widening, not shrinking. Paper says one number, but try to buy at that number and you can't. You pay the paper price plus $5, plus $10, plus $15 premium. And those premiums tell you what the real price actually is. This has happened before in other markets. When paper price lags physical reality for too long, paper eventually snaps to catch up. And when it does, it doesn't happen slowly, it happens all at once. We saw this with palladium years ago, where paper and physical completely disconnected. We saw it with certain oil contracts. We saw it in platinum. History doesn't repeat, but it sure does rhyme. And right now, silver is humming the same tune. Mining companies should be celebrating right now, but many mining stocks haven't caught up yet. There's a lag that creates opportunity. Their costs didn't change overnight. The amount of silver they pull out of the ground costs the same this week as it did last month. The diesel fuel costs the same. The workers get paid the same. The electricity bills are the same. But the revenue per ounce just jumped dramatically. That extra margin flows straight to profit. It's pure upside. Imagine running a business where your costs stay flat but your revenue doubles. That's what just happened to silver miners. And yet the stocks are still trading like nothing changed. Why? Because the market is slow. Because analysts haven't updated their models yet. Because institutional investors need to see a full quarter of results before they believe it's real. That lag creates opportunity for people paying attention. Metals typically move first. Stocks follow later, sometimes weeks later. And when analysts finally update their models and earnings estimates, when the hedge funds finally notice, revaluation happens fast. By the time CNBC is talking about it, by the time it's on the front page, the easy gains are gone. So where does this go from here? That's the question everyone wants answered. That's what keeps people up at night. Above the recent price levels, there's very little historical resistance. The chart is in open air. That means traditional technical analysis becomes less useful. There are no old highs to reference, no previous sellers to worry about. Psychology takes over. Round numbers start to matter more than support and resistance levels. Traders look for clean numbers to place orders. 90 becomes a target, not because of any fundamental reason, but because it's a round number. 100 becomes a target. 125, 150. These psychological levels become self-fulfilling because enough people think about them. The biggest mistake people make right now is emotional selling. They see profit on paper and they can't help themselves. They cash out, they take chips off the table, they lock in gains. But think about what that means for a moment. You're selling an asset that's rising because currency is failing, and you're converting it back into the currency that's failing. Does that make sense? If silver is going up because trust in money is going down, if silver is rising because people are losing faith in paper, then trading silver for paper is backwards. You're exiting the lifeboat to get back on the sinking ship. Smart capital doesn't retreat into cash during a currency crisis. It rotates into other hard assets or productive investments. It stays out of the broken system. It finds the next opportunity without going back to dollars. There's a ratio between gold and silver that serious investors watch closely. It tells you when silver is expensive relative to gold and when it's cheap. Historically, that ratio averages somewhere between 50 and 60 to 1, meaning it takes 50 to 60 ounces of silver to buy 1 ounce of gold. Right now, even after this move, even after silver's explosive gain, silver is still undervalued compared to gold by historical standards. The ratio is still too high. That means this move is early, not late. There's still room to run before silver becomes overvalued on a relative basis. If silver just returned to its historical average ratio, we'd be looking at significantly higher prices from here. And here's something critical that tells me we're still early. Public participation hasn't even started yet. Right now, the move is being driven by institutions, algorithms, arbitrage traders, industrial buyers, and people who pay attention to markets full-time. Regular retail investors, the average person working their 9-to-5 job, they don't even know this is happening yet. They're not talking about it at dinner. They're not asking their friends about silver. They're not Googling how to buy silver or why is silver going up. That comes later. That comes when the move is mature. The real frenzy happens when everyone suddenly cares. When your coworker who never mentions investing brings up silver. When your family group chat starts discussing metals. When your neighbor asks if they should buy some. That's when you know the move is in its final stages. We are not there yet. We're still in the early phase where most people are confused or completely unaware. And that's actually bullish. That means there's still fuel in the tank. There's an old saying in markets that veteran traders know well. When your taxi driver gives you stock tips, it's time to sell. When your barber talks about real estate, the bubble is near the top. When shoeshine boys are discussing the market, you're at a peak. Right now, most people couldn't tell you what silver did this week. Ask 10 random people on the street what silver's trading at, and 9 of them won't have any idea. That silence, that lack of awareness, that's actually a bullish sign. It means the move still has room to run before it gets crowded. It means smart money is still accumulating while dumb money is still sleeping. Let me be very clear about something before we go further. I'm not telling you to buy anything. I'm not giving you financial advice. I'm not your broker or your advisor. I'm showing you what's happening and why it matters. What you do with that information is entirely your decision. You're an adult. You can think for yourself. But understanding market structure, recognizing when something fundamental shifts, seeing the signals that others miss, that's a skill that serves you far beyond any single trade. That's the skill that builds real wealth over decades. The financial system is under stress. That's not conspiracy theory, that's just observation. Look around. Currencies are losing purchasing power year after year. Your dollar buys less today than it did 5 years ago. Debt levels are unsustainable. The United States government adds trillions to the debt every single year with no plan to ever pay it back. Trust in institutions is declining. People don't believe the official numbers anymore. They don't trust the media, they don't trust the government, they don't trust the banks, and when trust erodes, people move to things that can't be printed, can't be manipulated by committee decisions, and have held value for thousands of years. That's what's driving this. Silver isn't running because it's exciting or because some YouTuber pumped it. It's running because it's needed. It's running because people are looking for alternatives to a system they no longer trust. Think about what money actually is for a moment. It's supposed to be 3 things: a store of value, a medium of exchange, and a unit of account. But when central banks print trillions out of thin air, when government debt exceeds the entire economy, when inflation eats away purchasing power year after year, money stops functioning properly. It fails at its primary job. It becomes a hot potato that nobody wants to hold long term. You can't save in it because it melts. And that's when people remember that for most of human history, real money was metal. Gold and silver weren't chosen arbitrarily by some ancient king. They were chosen because they're scarce, durable, divisible, fungible, and impossible to counterfeit. They're money because of their physical properties, not because someone declared them to be. Modern currency is none of those things. It can be created infinitely at the press of a button. It degrades in value constantly and by design. Central banks target 2% inflation, which means they're explicitly trying to make your money worth less every year. And the only thing backing it is trust in the government that issues it and the threat of violence if you don't accept it. When that trust weakens, when people start questioning whether the government can actually make good on its promises, the entire system wobbles. And we're seeing that wobble right now, not just in silver, but across multiple asset classes. Real estate, stocks, commodities, crypto, art, collectibles, they're all reflecting the same underlying problem: too much money chasing too few real assets. And that problem isn't going away, it's getting worse. Silver sits at an interesting intersection that makes it uniquely valuable. It's both a monetary metal and an industrial commodity. That dual nature makes it different from everything else. Gold is primarily monetary. People buy gold to store wealth. Copper is primarily industrial. People buy copper to make things. Silver is both. It's money and it's material. And that means it responds to both safe haven demand and industrial demand at the same time. When both forces align in the same direction, when both are pushing higher simultaneously, the move is powerful. And right now, we're seeing exactly that alignment. Safe haven demand is rising as people lose faith in paper currencies. They see inflation, they see debt, they see money printing, and they want out. Industrial demand is rising as the world builds out solar infrastructure, electric vehicles, and advanced electronics. Every major economy has committed to green energy transitions. That requires massive amounts of silver. Both trends support higher prices. And both trends are likely to continue for years, not months. This isn't a trade. This is a structural shift that plays out over a decade. The solar industry alone is a massive consumer of silver, and it's only getting bigger. Each solar panel contains a significant amount of silver in the photovoltaic cells that convert sunlight to electricity. There's no substitute that works as well. Silver is the most conductive metal. As countries push for renewable energy, as they set targets for 50% solar or 70% renewable, solar installations are growing exponentially. China is building solar farms the size of cities. Europe is covering every roof. America is finally catching up. That means silver demand from just this one sector is climbing fast. And unlike investment demand, which can reverse quickly when sentiment changes, industrial demand is sticky. Once a factory is built, once production lines are running, once panels are installed, that demand doesn't disappear overnight. It's locked in for decades. Electric vehicles use significantly more silver than traditional cars. The wiring, the electronics, the battery management systems, the charging infrastructure, all of it requires silver. As EV adoption accelerates globally, so does silver consumption. And we're still early in that transition. Most cars on the road today are still internal combustion. The shift to electric is going to take decades. Europe has banned new gas car sales starting in 2035. California is doing the same. Other states are following. That's decades of increasing silver demand. Millions of vehicles per year, all requiring more silver than the cars they replace. Then there's the defense sector, which nobody talks about but matters enormously. Military applications require silver for electronics, missile systems, radar, guidance systems, weaponry, and more. And with geopolitical tensions rising globally, with wars breaking out, with superpowers competing again, defense spending is increasing everywhere. Countries are rebuilding stockpiles, modernizing equipment, and preparing for potential conflicts. America just passed another massive defense bill. China is expanding its military. Russia is at war. That's more silver demand. That's not price sensitive at all. The military doesn't care if silver costs $30 or $90 per ounce. National security isn't negotiable. They buy what they need regardless of price. Medical applications also consume silver in ways most people never consider. It's used in bandages for burn victims because of its antimicrobial properties. It's used in coatings for medical devices to prevent infections. It's used in certain treatments and diagnostic tools. As healthcare advances and populations age, medical demand grows steadily. Again, this is demand that's not optional. Hospitals don't skip buying critical supplies because the price went up. They pass the cost along or absorb it. Either way, they buy what they need. So you have this perfect storm where industrial demand is rising across multiple sectors at the same time that investment demand is surging due to monetary concerns, and supply isn't keeping up. Silver mining is difficult and expensive. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. Only about 30% comes from primary silver mines. You can't just decide to mine more silver when the price goes up. It doesn't work that way. Mine development takes years. Permitting takes years. Building infrastructure takes years. Supply is relatively fixed in the short term. There's no way to quickly respond to higher prices with higher production. And here's something most people don't realize that's actually terrifying when you think about it. A lot of silver is consumed, not recycled. When it's used in electronics or solar panels or medical applications, recovering it is often not economically viable. The amounts are too small and too dispersed. It's physically impossible to extract profitably. So that silver is effectively gone from the market forever. It's locked up in landfills or products for decades, unlike gold, which is almost entirely recycled. Because every ounce is valuable enough to recover, silver has a significant consumption component. Every year, a portion of above-ground supply disappears permanently. That makes the supply situation even tighter over time. The supply deficit has been building for years and nobody paid attention. Annual silver consumption has exceeded annual mine production consistently. The gap has been filled by existing stockpiles and recycling. But stockpiles aren't infinite. They get drawn down year after year. At some point, they run low enough that the market has to adjust. And when that happens, price has to rise enough to either reduce demand or incentivize more supply, or both. We might be approaching that inflection point right now. We might be at the moment where the market finally says enough, the old price doesn't work anymore. We need a new equilibrium. The The move you just witnessed could be the market's first real attempt to find a price level that balances supply and demand properly. $30 wasn't enough. We know that because deficits continued. 40 wasn't enough. 50 might not be enough. The market will keep pushing until it finds equilibrium. And given the structural deficit, given rising demand across multiple sectors, given falling stockpiles, equilibrium might be much higher than most people expect. Some analysts are talking about triple-digit silver. Some are talking about silver outperforming gold by multiples. Are they right? I don't know. Nobody knows. But the setup is there. The fundamentals support it. The technicals support it. The sentiment hasn't caught up yet, which means there's room to run. If you've made it this far in the video, you're already ahead of most people. Seriously. Most people can't focus for 30 seconds, let alone 30 minutes. You're willing to spend real time understanding something instead of relying on headlines and sound bites. That puts you in a different category. But understanding isn't enough. Knowledge without action is just entertainment. You have to act on what you understand. Not recklessly, not emotionally, but deliberately. You have to position yourself for what's coming instead of reacting to what already happened. And you have to keep learning because markets evolve constantly and what's true today might shift tomorrow. This is exactly why dark economy exists, to cut through the noise and give you clear explanations of what's actually happening in financial markets. Not what should happen in theory, not what we hope happens, but what is happening right now based on observable evidence and logical reasoning. If that's valuable to you, if you want to keep getting this kind of analysis, make sure you're subscribed because what comes next is going to matter even more than what you just heard. Click that subscribe button if you haven't already. Turn on notifications so you don't miss the next video. The silver move is just a symptom. The real story is much bigger and we're going to cover all of it. Drop a comment below right now and tell me what you think about this move. Are you watching silver? Do you own any? Do you think this continues or reverses? Are you seeing shortages in your area when you try to buy physical? What are dealers telling you? I read every comment and I respond when I can. Your engagement helps this channel reach more people who need this information. The algorithm rewards videos that people interact with. So comment, like, share. Hit that share button and send this to someone who still thinks the system is stable and nothing is changing. They need to see this. They need to understand what's happening before it's too late to position themselves properly. The move we just witnessed in silver is not the end of a story. It's the beginning. Markets are waking up to a reality that's been building for years under the surface, and the people who recognize that early, who adjust their understanding and positioning before the crowd figures it out, those are the people who navigate what comes next successfully. Those are the people who protect their wealth and even grow it while others panic. Everyone else reacts too late and pays the price. Don't be everyone else. Don't be the person who understands what happens 6 months after it's over. Stay informed. Stay ahead. Stay skeptical of official narratives. Think for yourself. And I'll see you in the next video where we will dive even deeper into what this means for your financial future and what you should be watching for next.